every country you've ever heard of is in debt. The United States, China, Japan, Germany, Britain, all of them owe enormous amounts of money. Trillions of dollars, euros, yen, and pounds stacked on balance sheets that seem impossible to ever pay back. And yet, the global economy keeps moving, governments keep spending, markets keep functioning. So here's the question most people never stop to ask. If every country is in debt, who exactly is the money owed to? Debt always has a lender. Someone, somewhere, must be the creditor. But when you look around and realize that nearly every nation on Earth is borrowing, the idea starts to feel like a paradox. It feels like a system that shouldn't exist, and yet it does. In this video, you're going to learn who governments actually owe money to, how national debt really works behind the scenes, why countries can remain in debt for decades without collapsing, and what all of this quietly means for ordinary people living inside these systems. By the end, the idea of national debt will look very different from how it's usually presented, not as a ticking time bomb, but as a carefully balanced system built on trust, confidence, and history. Welcome to The Money Historian TV, where we explore how money, power, and economic systems evolve over time and how decisions made long ago still shape the world we live in today. To understand who the creditor really is, we first need to clear up a common misunderstanding. When people hear the phrase national debt, they often imagine one country borrowing money from another, like a giant international credit card. In reality, that's only a small piece of the story. National debt isn't a single bill that arrives in the mail. It's not something a government has to pay off all at once. Instead, it's made up of thousands of promises, spread across time, institutions, and entire populations. At the center of this system is something called a government bond. A bond is simply a promise. A government says, "Lend us money today, and we'll pay you back later with interest." These bonds can last for months, years, or even decades. And unlike household debt, governments don't borrow because they're running out of money. They borrow because borrowing is built into how modern economies function. Here's where things start to get interesting. The largest creditors to most governments are not foreign countries. They are their own citizens and institutions. Pension funds buy government bonds to secure retirement income. Banks hold them as safe assets. Insurance companies rely on them for stability. Even ordinary people, through savings accounts and retirement plans, often own government debt without realizing it. In other words, a large portion of what governments owe is owed internally. This is why national debt doesn't behave like personal debt. When a government pays interest on its debt, that money doesn't vanish. It flows back into the economy, often to the very people living within the country itself. The system feeds itself, slowly, predictably, and by design. But internal lenders are only one layer of the story. There is another player, far more powerful and far more misunderstood: the central bank. Central banks exist to stabilize economies. They control interest rates, manage inflation, and act as lenders of last resort. But they also buy government debt, sometimes in massive quantities. When a central bank purchases government bonds, it creates money to do so. Not by printing physical cash, but by digitally expanding the money supply. This is often described as money printing, but in reality, it's a balance sheet operation, a swap of assets designed to keep the system liquid and functioning. This leads to a strange but crucial realization. In many cases, governments owe money to institutions that are directly connected to themselves. The line between debtor and creditor begins to blur. Debt becomes less about repayment and more about management, rolling old debt into new debt, adjusting interest rates, and maintaining confidence. At this point, a natural question arises. If governments can keep borrowing, refinancing, and expanding debt indefinitely, does it ever need to be paid back at all? Historically, the answer is no, at least not in the way people expect. Empires rarely eliminated debt. Instead, they managed it through growth, inflation, and time. As economies expand, debt becomes smaller relative to total output. Inflation quietly reduces the real value of what's owed, and bonds mature, get paid off, and are replaced with new ones. The system moves forward, not toward zero, but toward continuity. But this doesn't mean debt is harmless. The cost doesn't disappear, it shifts. Inflation reduces purchasing power. Taxes rise to service obligations. Savings lose value slowly, almost invisibly. The burden is spread thin, across years and generations, in ways that are easy to overlook, but impossible to avoid. So if every country is in debt, and the creditors are everywhere, citizens, institutions, central banks, what keeps the system from collapsing under its own weight? The answer is trust. Trust that currencies will hold value. Trust that governments will honor their promises. Trust that tomorrow's economy will be larger than today's. And when that trust breaks, history shows us what happens next. When people imagine national debt, they usually picture one country owing money to another. Headlines often reinforce this idea, warning that a foreign power owns another nation's debt. But once you look closer, this narrative begins to fall apart. Foreign creditors do exist, but they are rarely the dominant force people think they are. Take the United States as an example. Yes, other countries hold U.S. government bonds. Nations like Japan and China own significant portions. But even combined, foreign governments hold less than half of America's total debt. The majority is still held domestically by institutions, funds, and the Federal Reserve itself. This pattern repeats across much of the developed world. Governments are largely indebted to their own systems. So why do foreign governments buy another country's debt at all? The answer lies in trade and stability. When a country runs a trade surplus, exporting more than it imports, it accumulates foreign currency. Instead of letting that currency sit idle, governments often invest it in what they believe is the safest asset available. For decades, that asset has been government bonds issued by powerful, stable economies. This brings us to one of the most important concepts in modern finance, the reserve currency. A reserve currency is a currency held in large quantities by governments and institutions around the world. It's used for international trade, global debt, and financial stability. Today, the US dollar dominates this role. Oil, commodities, and international contracts are priced in dollars. Central banks hold dollars as reserves. Global trade flows through dollar-based systems. This status gives the issuing country a unique advantage. Because the world needs dollars, there is constant demand for U.S. government debt. This allows the United States to borrow at lower interest rates and roll over debt more easily than most nations. In simple terms, the system depends on the dollar, so the dollar's debt is treated as a feature, not a flaw. But reserve currencies are not permanent. History shows us that they rise and fall. The British pound once dominated global trade. Before that, Dutch guilders. Before that, Spanish silver. Each system lasted until economic dominance shifted, confidence eroded, and a new center of gravity emerged. What's critical to understand is that debt itself doesn't destroy these systems. Loss of trust does. When confidence remains high, debt can grow without triggering collapse. Investors keep lending. Bonds keep selling. Governments keep functioning. But when trust weakens, due to political instability, runaway inflation, or economic mismanagement, the cost of borrowing rises rapidly. Interest rates spike. Refinancing becomes difficult. And suddenly, debt that once seemed manageable becomes suffocating. This is why financial crises often appear sudden. The numbers don't change overnight. The belief does. Consider countries that don't control their own currency. Unlike nations with independent central banks, these governments must borrow in foreign currencies. They can't create money to service debt. They can't stabilize markets through bond purchases. When investors lose confidence, there is no safety valve. This is why emerging market crises tend to be faster, harsher, and more devastating. For countries with monetary sovereignty, the game is different. Debt becomes a tool, not a sentence. It can be extended, restructured, inflated away, or absorbed by central banks. The system bends, sometimes uncomfortably, but it doesn't immediately break. This leads to a strange but powerful conclusion. The global debt system isn't held together by repayment. It's held together by belief. Belief that governments will continue to exist. Belief that currencies will remain usable. Belief that growth, innovation, and productivity will outpace obligations. As long as that belief holds, the system survives. But belief is fragile, and history is filled with moments when it cracked. In the final part of this story, we'll look at who truly pays when debt grows unchecked, how inflation quietly transfers wealth, and why the biggest risks in today's global system aren't always where people expect them to be. So if debt is mostly internal, managed by central banks, and supported by global trust, you might wonder, who actually pays the price? The answer is subtle. It's not usually the politicians signing the bonds, or even the banks holding them. It's the people living in the system, often in ways they barely notice. Inflation quietly erodes savings. Taxes rise to service obligations. Public services can be stretched thinner to meet interest payments. Even small decisions, like the timing of when a government issues new debt, ripple outward, affecting pensions, mortgages, and daily life. Debt becomes a hidden force, shaping economies without headlines. At the same time, modern financial innovations can amplify risk. Complex instruments, derivatives, and global interconnections mean that one miscalculation in a faraway market can cascade across borders. History is full of examples. From the 1920s debt cycles to the 2008 global crisis. The lessons are clear. Debt itself isn't inherently dangerous. Misunderstanding, it is. Yet, even with these risks, the global system endures. Countries with control over their own currency can roll debt forward indefinitely, using central banks as stabilizers. Nations with reserve currencies enjoy extra flexibility, while others must navigate the tightrope of foreign-denominated obligations. It's a delicate balance, a combination of math, psychology, and trust. So when you hear that every country is in debt, don't panic. Understand the structure. Look at the layers: internal debt, foreign creditors, central banks, reserve currencies, and the invisible hand of confidence that keeps everything running. Realize that debt isn't a villain. It's a tool. Managed wisely, it can fuel growth and stability. Mismanaged or misunderstood, it can trigger crises that echo across generations. In the end, the story of global debt is the story of human belief. Money has value because we agree it does. Bonds work because we trust promises. Systems survive because people keep believing in them, even when the numbers seem impossible. Debt isn't just numbers on a page. It's a reflection of confidence, history, and the intricate dance of economies over centuries. If this video has changed the way you think about debt, consider subscribing to the Money Historian TV, where we dive into the hidden forces behind global wealth, financial power, and economic history. Understanding the past isn't just a lesson, it's a guide to making sense of the world today. Stay curious, and the next story may just change the way you see money forever.